Hi, this is James, and today we're going to talk about the most important thing. And so this was a book written by Howard Marks in 2011. And then, so we're going to start super wide and then narrow down into his current memo that he just put out yesterday, March 31st, 2020, and sort of where we are today. And so Howard Marks actually first heard of him back, he was on the Tim Ferriss show, and then he essentially runs I guess you could call a hedge fund or debt yield fund, and is one of the most respected. And Warren Buffett said he is when his memos come out, it is the first thing Warren Buffett reads. And so I thought it'd be a great place to start. A little bit about my background. I was born and raised in Houston, Texas, and then went to school in Austin at UT, and I've been in DFW since 2006. Loan underwriter for 8 years at GE Capital, underwriting commercial properties of all types. And then the last 5 years have been really focused on multifamily, originating over 750 million in multifamily loans across 125 properties, and also invested in over 25 properties, totaling over 6,000 units in Texas. And so let's jump in here. And so Howard Marks sets the book up and essentially says the most important thing is X, and he goes through about 20 items. I sort of narrowed it down to the top 10, and so let's walk through these. I think these will really impact you as an investor. And so number one, second level thinking. And so thinking about the effects of the effects, right? So most people say, look, it's a good property, let's buy it. That's sort of first level thinking. Second level is it's a good property, but everyone thinks it is a good property, so it's overrated and overpriced, so we should pass on this deal. And so in my video yesterday, we really talked about second level effects of the economy stopping today, how that affects the tenants, how that affects the borrower, how that impacts the banks, and doesn't allow them to really securitize anything. And so going past that first level gives you an edge. And one of the things he mentioned was the ability to really create value in inefficient markets like real estate is a skill called alpha. And so you really need second level thinking to achieve this in inefficient markets. All right, number two is value. Understanding how to value a property is one thing, but then understanding where the value is in relation to the price you have to pay. And so value is the starting point. You have to understand intrinsic value. In real estate, we like to call that more like replacement cost. And the further away that gets from, in terms of a discount, then that gives you an advantage when buying, right? Because in essence, as you buy stuff, the thought is that it'll move closer and closer from price to that value that you think the property is actually worth. And so the easiest example for me is if somebody buys something, let's say per pound on a deal, a lot of times, let's say they're buying it on a per square foot basis, and they're saying, look, right now, if the property is 50% occupied, which in the past 10 years, there really hasn't been anything that's 50% occupied, but in the coming, 6 to 9 months, it could be, right? Or it could be 50% economically occupied. If that happens, there's essentially no income. And so how do you value a property that has no income or no NOI, right? Most of the time we're doing NOI divided by cap rate to come up with the value. But if there is nothing, no value, no NOI there, then how do you value it? And a lot of times it's going to be per pound, the intrinsic value. And then as the property increases in occupancy, increases in rent, then at that point it will be able to be traded for its true value. So if you can buy it at a price sort of per pound and then sell it on a value, NOI divided by cap rate, that's where you can make a lot of money. And so he really calls this control investors. And this is, increasing value through active management of the asset. All right, number three is risk. And so I spent 8 years in risk at GE Capital, and a lot of people said, hey, if I asked them, I was coming from finance into either risk or sales. And they said, look, just go into risk first because it will be the more beneficial thing for you long term. And so I spent 8 years in risk. And, this one chapter probably helped me more than those 8 years. So risk, investing consists of one thing, and that is dealing with the future. And since there's so much uncertainty, risk is almost inescapable. Your job is to best control it. And so this first chart on the top, I thought was a great representation of as you move further out in the risk, um, spectrum, further out to the right on the risk horizon, your returns they increase, but then the volatility of those returns increases as well. So let me give you an example. So let's say you're on the far left hand side, super safe deal. Let's say a Class A deal, fully stabilized, 99% occupied in the best location. Your range of returns is really going to be like 4% to maybe 5%, and that's it. It's really not going to move up or down that much, right? But then as you go further out in the risk curve, let's say you go tough neighborhood, super heavy value add, your range of returns could be 0 all the way up to 20%, let's say. And so that really changed how I thought about being compensated for the risk that I'm taking. And so, in a bull market, essentially that risk goes to 0, unfortunately. And some of the quotes here is risk control is invisible in good times. So, right, if you had, let's say, longer term debt, it didn't really matter, right? Because you bought a deal, sold it 2 years later or 3 years later, and you made a ton of money. But then now, if you have a short-term loan and you have 1 year left or 2 years left on that loan, it's going to become very evident if this economy, if this downturn lasts longer. Um, and so I like this quote. They said, there are old investors and there are bold investors, but there are no old, bold investors. And so I think over time, you are going to be, determined by how many losers you have and how bad they are, more so than the greatness of your winners. And so, um, I think one of the things that people get confused on is they look at absolute returns between investors. So they say, look, my one general partner, they're giving me 20% IRR consistently over the last 2, 3, 4 years, but then they're not really looking at the risks that they took to achieve the returns, right? So the absolute returns on a bridge loan heavy value add deal might be 20% IRR for the last 2, 3, 4 years. But then somebody who did more stabilized deal, light value add, high occupancy deals, they got 10 to 15%. And so when you look at the risk, you also have to look at the return that you're getting. And this bottom chart, it shows the risk return is sort of up and to the right, but then the people who can achieve a a return that's above that with the same amount of risk, that's really the value add piece. So those are the investors that you want to be working with. Number 4, most important thing is cycles. Rule number 1, most things will be cyclical. Rule number 2 is some of the greatest opportunities for gain and loss come when other people forget rule number 1. All right, so let's go through the 3 stages of a bull market, right? So number 1, when a few forward-looking people begin to believe things will get better, when most investors realize improvement is taking place, and then number 3, when everyone concludes things will get better forever. And so I would say, if you looked in the apartment market, I would say probably, 2012, 2013, there was a few people starting to start buy deals. 2014 to 2015, most investors realize improvements taking place. And then, probably the last 2 years, everyone concluded that everything will be better forever. And here he mentioned at the top of the cycle, worst loans are made at the best of times. And what the wise man does in the beginning, the fool does in the end. And so um, those are your three stages of the bull market. And then three stages of a bear market. Number one, when just a few investors recognize that there's bullishness coming, things won't always be rosy. Most investors recognize things are deteriorating. And then number three, when everyone's convinced things can only get worse. And so these come fast, right? And so if you look at this chart on the right, I would say, we hit that euphoria point 2018, 19, 20. We've now moved very quickly down into sort of that fear and panic mode right now, and we shall see how long we sit there. All right, number 5, contrarianism. So Warren Buffett obviously talks about this one a lot, but um, I like to use the example of a pendulum, right? And I actually thought this was easier in one of the first times I had seen this, but the pendulum being um, you're on the bear market, you're in the fear, and then you're also, it swings all the way to the greed side. And so the greed side, I would say, let's say 2018, 2019 is on the greed side, the bubble side. And then now, after coronavirus has come in and essentially shut it down, there was almost no time in that neutral spot. It just swung all the way back to the fear side. And so using that analogy, I thought was super helpful, because now you're really just looking at two things, like where are you on the pendulum, and you know, in terms of investing, I think it's important to see there's two elements of superior investing that he said is seeing some quality that others don't see or appreciate and hasn't been reflected in price. And number two, it has to turn out to be true, right? So if you're a pioneer in a market and you don't, let's say you're buying in a market that people don't see, it's not reflected in price, but then it doesn't come true, right? So if that huge mixed use was supposed to be right next to your property, it doesn't come true because of the downturn, right? So a couple other things he said for contrarianism is, we have to buy them when they hate them and sell them when they love them. I thought that was a great quote in that chapter. Number 6, patient opportunism. And so this is actually pretty hard. In my multifamily career over the last 5 years, it's always been the brokers. They list a deal and you go after them. And in 2015, there might be 10 people who make an offer. In 16, 17, there was 20 people who made an offer. Then 30 people who made an offer, best and final. And then now the pendulum is slowly changing, where it's saying, we listed the deal fell through, and now we're getting calls that, hey, do you have anyone to buy this property? Because we need someone to buy it because the sellers wants to sell and we don't have anyone at the table. And so he and Howard Marks in the book, he mentions we don't look for our investments, they find us. So whether that's through research or people knowing that they buy what they buy. And investing, he used the analogy of baseball. He said, in investing, you never have to swing, right? So as a batter in baseball, if you get 3 strikes, you're out. But in investing, you actually don't have to swing. Your only penalty is opportunity costs for losing deals. But the only penalty really is making losing investments and losing money. And so your bat should really come off your shoulder when there are opportunities for profit with controlled risk. And the best buying opportunities come when people are forced to sell. So nobody right now is forced to sell. It is April 1st and rent is due, but we'll see how many people pay. But when you are forced to sell, let's say there's this 50, 60, 70% drop in income in the next 3 months because of coronavirus, then people will be forced to sell. And your job as an investor, so the key during crisis is to be insulated from the forces that require selling, and number 2, be positioned to be a buyer instead. And so what do you need to be able to do this? You need reliance on value, little or limited leverage, long-term capital, and a strong stomach. All right, number 7, know what you don't know. So the most important thing is knowing what you don't know. So few people it's almost impossible to predict the macro future. Nobody had coronavirus baked into their model, or they would never have done a deal, right? So you need to concentrate on smaller picture things. And uh, he says, know the knowable. All right. So figure out where you stand in terms of cycles and pendulums. Figure out, uh, you know, where your time is going to be spent on knowing the knowable, right? So can you know a market better? Can you know property better? Focus on those things, because a lot of market forecasts are just extrapolations of the past, right? And your results are based solely on what happens in the future. So going back to this pendulum swing, it typically goes from euphoria to depression. It goes from all only looking at positives to only looking at negatives. And it goes from overpriced to underpriced. And so there's almost no time spent in that neutral. And so you have to be ready for those pendulum swings. Um, so the people who don't know the future, number one, they're going to diversify, they're going to hedge, they're going to leverage less, and then they're going to emphasize value today over growth tomorrow. They're going to stay high in the capital stack, and then they're going to be able to ride out a variety of possible outcomes, right? So you have longer term debt, you have a lot of reserves, then you're going to be able to, your return might not be as high going back to that chart, but then your range of returns will be positive and in a tighter, narrower band versus some of those larger volatilities. All right, number 8, the most important thing is having a sense of where we stand. So you can't predict the future, right? So just throw that out, but you can figure out where we stand. And so you have to be alert when the market has reached an extreme and adjusting your behavior. And the 7 scariest words for any investor is too much money chasing too few deals. And so here's a snapshot of his guide to market assessment. So it really looks at the economy, what lenders are doing, what the capital markets are doing, what investors are doing, what are sellers doing, recent performance, asset prices. And you sort of go down and it gives you an idea of all those. If it's heavily on, let's say, the left hand side, where economy is vibrant, lenders are loose with terms, interest rates terms are easy, investors are eager to buy, there's not that many sellers. That's just, on that pendulum side, that is approaching euphoria. Whereas on the right hand side, if the economy is sluggish, outlook is negative, capital markets are super tight, banks won't lend, high interest rates, everyone's pessimistic, nobody wants to buy, asset owners are rushing for the sale, then that's when the pendulum has swung the other way and you are moving towards that recession. All right, number 9, the most important thing is investing defensively. So he compared, investing is a lot like sports. He compared it mostly to soccer, right? Because you have to play both sides of the field, right? You have to play offense, you have to play defense. And, his 2 elements of defensive investing is really around exclusion of losses through due diligence, high standards, demanding a low price and a margin of error, and then avoiding just the poor years, right? So just timing of the cycles is his defensive strategy. And, his biggest thing is avoid the losers and the winners will take care of themselves. And so he said, many investment managers, that could be general partners, that could be guys investing in the stock market, hedge fund guys, their careers don't end because they fail to hit home runs. Rather they end up out of the game because they strike out too often. So not because they don't have enough winners, but because they have too many losers and people stop investing with them. Number 10, so it really leads up to avoiding pitfalls, right? So, portfolio can contain too little risk, right? And so you might underperform a little bit, right? So if you took, let's say, Fannie or Freddie debt and you had to sell in the past couple of years, you had to pay a penalty or you had to do a loan assumption, and you made less, right, than someone who took a bridge loan and they only had a 1% prepay. But no one ever went bust from that, right? And so in bullish markets, you're not going to make as much, right? So, in terms of avoiding pitfalls, there isn't going to be a perfect investment, right? But you can make a lot of really good investments and exclude the bad ones. And I like this story. He said, never forget the 6 foot tall man who drowned crossing the stream that was 5 foot deep on average, right? So have a margin of error, gives you staying power, gets you through those low spots. So here in summary, the 10 lessons: second level thinking, value, risk, cycles, contrarianism, patient opportunism, knowing what you don't know, having a sense of where we stand, investing defensively, avoiding pitfalls, were the 10 most important things. And these three charts on the right-hand side really stood out to me. The first one, the risk return threshold, in that your risk as it increased, yes, the returns could be higher, and those are forecasted higher because there's no doubt that people should receive higher returns, but then the range, the volatility of your returns is significantly higher. And then going into the cycles, right? So, we hit euphoria. We're in the now, probably the last year, but then now we're right in between that sort of fear and panic, I would say. And I don't know how long we're going to sit there, but that's sort of where we're sitting right now. And then remember the pendulum, right? So the fear becoming greed. And then once it becomes greed, then it switches back to fear so quickly. So watching that pendulum and thinking about understanding where we are in the market. So final thoughts, thoughtful investors can toil in obscurity. They're getting good returns, but they avoid sharing in the riskiest behavior, and they keep their egos in check. So this is the greatest formula for long-term wealth creation, but it doesn't provide much ego gratification in the short run, right? You're seeing everybody out there killing it, making tons of returns, selling deals in 18 months and a ton of money. It's not glamorous to follow a path that emphasizes humility, prudence, and risk control. But of course, investing shouldn't be about glamour, but often it is. Invest scared, require good value, require a substantial margin of error, and be conscious of what you don't know and can't control. And those are the hallmarks of the best investors. An investor's time is better spent trying to gain a knowledge advantage regarding the knowable, whether that's industries, companies, securities. The more micro you're focused, the greater likelihood you can learn things others don't know. All right, so let's get into his last memo. His last memo came out yesterday, Which Way Now? And here he really talks about, all right, Robert Kiyosaki talks about knowing both sides of the coin and sitting on the edge of the coin. And he presents two sides, right? A positive side and a negative side. And then where, as he sits on the edge, what he thinks it's going to go. And number one, positive, right? So what are some positive things that could happen? Number one, the virus could be under control, right? In a lot of markets, China, these things are getting under control. Economy is coming back. The government is going to provide life support during this whole time. And then, everything opens in, let's say, 6 weeks. Economy is back in 6 months. Low gas prices, 0% interest rates, and we're back. That's more of like a down and straight back up. That's like a V. On the negative side, the U.S., the cases are still growing, lack of testing. This is a large economic contraction, unemployment 10 to 20%. GDP for the second quarter is going to be down 15, 20%. How do you resolve sort of social isolation versus the economic recovery? Oil is super low. That's going to lead to job losses in a lot of major markets. And then, with unemployment at 20%, it might take 1-2 years to get back to normal. And so with social isolation, disease and death, economic contraction, enormous reliance on government action, uncertainty about long-term effects, and questioning how far they will go, he expects asset prices to decline. And he says, be ready to take advantage of declines. So I see us right in between that fear and panic right now. And, on the pendulum side, all the way over onto the bear side right now. And so prepare accordingly. So if you like this video, like the video, subscribe to the YouTube channel. And if you want to talk about buying, selling, refinancing your next multifamily deal, send me an email. I'd love to talk to you. And then also, if you haven't, this is a great time. There's not a lot of deals on the market right now. So start getting educated, right? So start understanding the financing options that are out there. Start understanding what the qualifications are really to get out there and be ready to buy a deal if this market improves and you start seeing deals come to market. So appreciate everyone's time, and I'll talk to you soon. Thanks.